So good morning. Yes, indeed, our trajectory is very solid. This year has been a very strong year. We are now benefiting from 95 billion euros of backlog. We have almost fully deleveraged the company, both by inorganic measures as well as by our own cash generation. We have reoriented the companies towards more and more services, towards more and more signaling. And as you have mentioned, our profitability has increased significantly, 18%. Our net income is now around 500 million euros, in line with our free cash flow generation. And indeed, we want to deleverage completely the company. And that's why we have decided to wait for this neutral cash position to arrive before coming back, resuming with dividend distribution.
So what would you say is the likelihood of announcing a dividend at the next full year?
Well, you know, we have confirmed, which is extremely important, I would say, both for the investors and the rating agencies, we have confirmed our guidance of generation of 1.5 billion euro of cash over 3 years. We have generated 500 during the first year, so we are totally in line with this trajectory. We have a net debt of 400 million euros. So if we continue with this trajectory, we should be in a neutral cash position as soon as next year. But of course, the board will have to decide at that point.
I would also like to understand a little bit more how changes in trade policy might have impacted your business. What are you seeing on that front?
Well, first and foremost, over the last decade, we had a 10-year journey where we have built a multi-local business model. We are the unique railway manufacturer which is present on all main markets in the world, physically present with factories, engineering centers, and so forth. So overall, we are not impacted by the current macroeconomic environment and by the tariffs. If you take the US, for example, we are extremely present in the US. We have several factories, service depots, signaling centers, and so forth. So we are already physically present on all our markets. So nobody can be fully immune from what's happening, but frankly, our business model is extremely resilient and can weather the situation.
I would also like to understand a little bit better, where do you think you've announced a higher margin going forward, higher margins going forward. I'm wondering, what is the part of the business that is fueling that activity?
Well, we have two main drivers for this increase in margin. The first one is a change in mix. We have a unique service activities. I think our size is 3 times our closest competitor. This service activity is going extremely fast, and if you look at the order intake this year, it has a book-to-bill of 1.8. This service activity has, in general, a higher margin than the rest of the activity. So this drives the margin upwards by a mix impact. Then we are improving the execution of our projects. Now the Bombardier acquisition is fully integrated, fully behind us, and we are ramping up, accelerating the improvement in our project execution, in the quality of our backlog, including on rolling stock. And this will also drive the margin upwards going forward. By the way, the margin which is already in our backlog is fully in line with this guidance. So we have already in our backlog what to deliver.